Well, welcome to our High Rock clients and any other listeners on this snowy Tuesday afternoon in Toronto. And thanks for taking the time to tune in to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategy. So sit back, relax, and perhaps grab a glass of wine, unless, of course, you have resolved not to drink in January. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of High Rock. Our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About High Rock tab. So, what's happened since our last webinar? Well, in the land of Google searches, the most popular focused on Forrest Goodluck, who made his movie debut in The Revenant movie with Leonardo DiCaprio. Sean Penn, who interviewed with Mexico's notorious drug kingpin El Chapo. Donald Trump says the NFL is going soft. U.S. Powerball lottery is now worth $1.5 billion. The Golden Globe Awards happened. Jenna Dewan happened, whoever she is. The Pittsburgh Steelers. And music, fashion, and art legend David Bowie passed away from cancer at the age of 69. Meanwhile, financial topics were not among the top searches, so we are here to tell you all that you need to know about what happened in the last week as far as financial markets are concerned. Well, let's start with fixed income. More bank issuance of fixed rate reset preferred shares to start the year has put pressure on that market as supply concerns continue to overwhelm demand. Canadian high yield was up slightly. Government bond markets were also up some. Canadian and U.S. 10-year yield spreads widened to 87 basis points from 85 last week as the two economies continue to diverge. Well, volatility, one of our key themes for 2016, started the year by jumping higher. Our benchmark World Equity Index had a rough week and is lower by a little under 6% on the year, led by China and Japan. Not a single equity market that we follow here was positive over the course of this week. As I mentioned, volatility touched the highest level since last August to start the year and is well above its long-term averages. We expect this condition to continue as long as there is uncertainty surrounding China, commodity prices, central bank monetary policy divergence, and the state of the U.S. and global economies. Volatility rises when markets become fearful, and we can see this in the CNN Fear and Greed Index. Well, the downtrend continues for global equity markets. Human beings are emotional, and fear is an emotion. There are those who trade in the markets that will prey on this emotion, driving prices lower by selling equities that they don't own in order to buy them back at lower levels in the future. We call this short selling. Now, as fear builds, investors panic, and this is what we call an oversold market, and they sell to those who are already short. We call this short covering. Usually this occurs when a market moves lower quickly and the fear factor gets to a peak. We believe that we are close to this level and that markets are becoming oversold. Our benchmark all-country world index is down close to 18% from the highs, not far off the lows recorded in August. While markets rarely move in one direction for a significant period, short sellers may take profits and bring buying back to the market when the fear is greatest. We may be close to this for the time being until there is a definitive change in the trend. Any bounce higher in prices is probably not a good buying opportunity, but likely a good selling opportunity, especially for short sellers. We think that the downtrend may have further to go, and we will not be aggressive buyers in the market at this time. Well, oil prices have been the big story this week, dropping 13.5% since the last time we spoke, almost 14, or a little over 14% lower on the year. Copper, also a metal that has historically been a benchmark for the global economy, was significantly lower. Well, oil is making new lows below the lowest levels of 2008. Copper and oil have been pushing the Bloomberg Commodity Index to its multi-year lows again this week. And this has driven the Canadian dollar to new lows, a level not seen since 2003, breaking that psychological 70-cent barrier earlier today. This may be very close to the lows that we expect, and we may well see a move back towards the 135 level, or 74 cents next. Well, the World Equity Index is comprised of about 52% of U.S. companies, so we keep a close eye on what is happening in the U.S. economy. Well, the U.S. Federal Reserve raised interest rates in mid-December, citing that they saw improving economic conditions and expected inflation to move toward their target 2% level, and that future increases were expected to be gradual. They meet again at the end of January. With their optimistic economic outlook, the Federal Reserve governors indicated that they expected an average of 4 interest rate increases in 2016. Well, they got good economic news last Friday as the U.S. widely watched U.S. non-farm payrolls jumped just a little under 300,000 to 292,000, well above the expected 200,000. Now, the gain was led by professional and business services at plus 73,000, which is considered a leading component for future hiring. As well, there were upward revisions of 50,000 to the previous months. Unemployment remained at the 5% level as labor force participation rate moved off of its lows to 62.6 from 62.5%. The most recent 3 months have been strong, which may bolster the Fed in their desire to raise interest rates. But the yearly trend continues to move lower. Further uncertainty comes with the lack of inflation seen in wage growth, which was unchanged in December, but expected to be higher by 0.2%. As well, a more leading indicator of U.S. economic growth is the data for those reporting new unemployment claims, which are compiled weekly to show the number of individuals who filed for unemployment insurance for the first time. Since late October, that number has actually been climbing. As well, further, fourth quarter U.S. GDP expectations are running well below earlier targets, leaving plenty of uncertainty as to the validity of the 2.5% GDP growth expected in the U.S. in 2016. Now, around the rest of the world, Euro area companies represent 16% of the World Equity Index. The European Central Bank eased monetary policy on December 3rd, but it was less stimulative than the markets had expected. European Central Bank President Draghi will speak this Thursday, and the European Central Bank will announce their latest interest rate policy on Thursday, January the 21st. In the most recent economic data, consumer confidence in the euro area increased to a negative 5.7 in December from a negative 5.9 in November. The business climate indicator for the euro area increased slightly by 0.5% in December. Managers' appraisal of total and export order books, as well as their production expectations, improved. Past production was assessed slightly more negatively, while views on the current stock of finished products remained broadly unchanged. The general economic sentiment, including consumers, was up at 0.7%. Well, Japanese companies represent 8% of the World Equity Index. The Bank of Japan kept its pledge to increase the monetary base at an annual pace of about 80 trillion yen in its December 2015 meeting, but said it would extend the average maturity of government bonds it purchases. Policymakers also established a new program of buying exchange-traded funds. The Bank of Japan will announce their next decision on interest rates at the end of January. Well, consumer confidence in Japan rose to 42.7 in December from 42.6, so not significantly, but it was above the market consensus of 42.3 and is the highest reading since September of 2013, mainly due to higher income growth. The Bank of Japan's quarterly Tankan Index of Sentiment at large manufacturers was steady at 12 in the fourth quarter of 2015, slightly above market expectations of 11. Well, companies in the UK represent 7% of the global equity index. The Bank of England's Monetary Policy Committee voted by a majority of 8-1 to maintain the bank rate at 0.5% and unanimously to leave the stock of purchased assets at £375 billion at its December 2015 meeting. This was all widely expected. The Bank of England announces its next interest rate decision this coming Thursday. Consumer confidence in the UK was at 2 in December, up from 1 in November, while the index of economic situation over the next 12 months was stuck at its lowest level since July of 2013. Overall, this is the first time in the survey history that the index remained positive for an entire calendar year. The CBI business optimism in the UK for the last 3 months of 2015 decreased to a negative 12% from 8% in the previous period, reaching the lowest level since the last quarter of 2012. Well, Chinese companies represent about 2.5% of the world equity index. China's central bank injected 130 billion yuan, or 20 billion US dollars equivalent into the financial system on January the 5th, 2016. It was the biggest cash injection since September. China's annual inflation rate was recorded at 1.6% in December as compared to 1.5% in the previous month, matching market consensus. In Canada, where companies represent 3% of the world index, the Bank of Canada also left its benchmark overnight rate on hold at 0.5% at its December meeting, saying inflation risks remain balanced while the economy continues to undergo a complex and lengthy adjustment to the decline in terms of trade. The Bank of Canada will announce its latest interest rate decision on Jan the 20th. It has been suggested by some that the bank may lower the bank rate at this time. Perhaps the Business Outlook survey has made an impact. Business sentiment has deteriorated while firms continue to anticipate an acceleration in their sales over the next 12 months. The diverging outlook evident in recent surveys persists. The low commodity price environment poses significant challenges for many businesses since the adverse effects of the shock are increasingly being felt across most regions and sectors. Expectations for future sales are more robust among exporters in light of strengthening foreign demand. Investment and hiring intentions have fallen to their lowest level since 2009 as domestically oriented firms and those exposed to the resource sector adjust their plans to slower activity. Yet, in response to stronger foreign demand, exporters not tied to commodities plan to increase their investment, supported by the boost of competitiveness from the depreciation of the Canadian dollar. Capacity pressures are still subdued, largely owing to weak demand conditions, especially for firms in the prairies. Excess capacity remains more prevalent among domestically oriented firms than among exporters, and firms continue to report that labor shortages are less intense than they were a year ago. Businesses expect input and output prices to rise at a slower pace, in part reflecting dissipating upward pressure anticipated by firms at the time of the survey from the depreciation of the Canadian dollar, as well as weak market conditions. Inflation expectations fell, with a greater share of firms expecting inflation to be in the lower half of the Bank of Canada's inflation control range. Overall, firms reported little change in credit conditions, while tighter credit conditions continue to be linked to the commodity sector. The most recent data from StatsCan show that employment edged up 23,000 in December, and the unemployment rate was 7.1%, unchanged from the previous month. Following employment growth of 0.4% in the first quarter of 2015, the pace of growth slowed to 0.2% for each of the subsequent 3 quarters in the 12 months to December. Employment gains totaled 158,000, or 0.9%, slightly above the growth rate of 0.7% in both 2013 and 2014. Provincially, employment rose only in Ontario, while it declined in Saskatchewan, Nova Scotia, Newfoundland, and Labrador, as well as Prince Edward Island. In December, employment increased 17% in healthcare and social assistance, 15,000 in educational services, and 10,000 in finance, insurance, real estate, and leasing. Conversely, employment declined by 14,000 in accommodation and food services, and 7,900 in agriculture. In December, the number of self-employed increased 40,000, which was basically the bulk of the increase, while the number of private and public sector employees was little changed. Okay, all of the current economic data now under our belts. What do we see coming on the horizon? Well, let's check in with the bond markets that tend to lead other financial markets. Canadian short-term yields have fallen as there are some expectations that the Bank of Canada may lower interest rates, but longer-term yields are little changed. U.S. short-term yields are higher after stronger employment data raised the likelihood of U.S. Fed rate hike in March. German short-term yields remain below zero out to approximately 6 years. Generally, flattening yield curves suggest weakening economies, and that may be an important indicator for the U.S. economy, as that yield curve has been flattening of late. In Canada, the yield curve steepened ever so slightly and does lessen the likelihood of a recession. Pretty much the same can be said of the UK, Germany, and Japan. Well, historically, high yield bond markets have led equity markets. Last week, the gap was quite wide, suggesting that equity markets could potentially fall further, and lo and behold, this week the gap narrowed considerably, suggesting that we should keep our eyes on this indicator for signs of any change in that trend that might indicate a near-term bottom to equity prices. So as we talked about the oversold nature of equity markets, as they do catch up, there may be other signs in some of the other indicators that we look at that there is potentially a near-term bottom. Well, when investors buy stocks, they buy a stream of future earnings. The price-to-earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price-to-earnings ratio is 14.2 times. The 12-month forward price-to-earnings ratio is currently at 15.7. Last week, it was at 16.2. At the equity market highs back in May, it was at 17.1. So equity prices have recently become cheaper, but they are still relatively expensive comparatively to the averages, the longer-term averages. It is earnings season at the moment, and for the fourth quarter of 2015, companies are expected to report year-over-year declines in both earnings of negative 5.3% and revenues of negative 3.3%. However, analysts do currently project earnings growth and revenue growth to return in 2016, starting in the first quarter. For the first quarter of 2016, analysts are currently predicting earnings growth of only 0.5% and revenue growth of about 2.3%. Without significant revenue and earnings growth expected in the future, it is difficult to find a reason to be buying equities at current levels. The market appears to be starting to understand this some. As for the other metric that we like to look at, enterprise value to earnings, S&P 500 companies are valued at current market prices at 12 times. The 10-year average is just a little under 10 times. Too expensive for our tastes at the moment. Well, margin debt, where investors and traders borrow to buy equities, is another indicator of the health of the stock market. In 2007, margin borrowing turned lower, and was followed by the S&P 500. Margin debt turned lower in May, and that raised warning flags for us. When the spread between large cap markets like the S&P 500 widens over small cap markets like the Russell 2000, it has been historically a sign of stock markets that are rising on the strength of fewer and fewer companies. That is considered unhealthy. That had been happening, and there had been a reasonably wide gap between the S&P 500 and the Russell 2000. But as markets have fallen over the last week, that gap has actually narrowed somewhat, which to us means that we may be getting closer to that temporary bottom that we've been talking about. Now, this would be in line with our belief that equity markets have become oversold. So what does it all mean? Well, last week we put forward our key themes for 2016. We expect that volatility will continue as financial market participants try to wade through all of the uncertainty. What this hinges on will be the impact the U.S. Federal Reserve policy has not only on the domestic economy, but how it plays out on the global scale. China's economic growth may be the wild card here. The big question is, will commodity prices find a bottom and start to move higher? It comes down to supply and demand. Supply has been continually building of late, and demand has not been able to keep up. If economic growth turns around, this story may change, but at the moment, it is hard to see this happening anytime soon. Will the Fed raise rates 4 times this year while other central banks are still stimulating their economies? The Fed is optimistic on the U.S. economy, but the U.S. domestic economy will be the key. Will it be able to support growth or get dragged down by the slow global economy and China? We see difficulties ahead for the U.S. economy. Well, rising geopolitical concerns with tensions in the Middle East growing. North Korea is flexing its nuclear muscle, and there is concerns about whether the UK will exit the European Union, and in the background there is always Greece. We think bond markets will continue to give us insight to what to expect from other asset markets, so we will need to keep a close eye on what they are telling us. And until there is a reasonable correction, equity markets do not represent value at the current levels, although there is certainly some correcting activity happening at the moment. But until economic growth can return to drive revenues and earnings, inflation moves higher, and so do interest rates globally, we will remain in a low return environment. Remember that we had almost 6 years of above average returns until last year, so we are closer to the long-term averages now, but it may be a while yet before we get back to better rates of growth. Well, if you wish to read a more in-depth report of our HIROC market view for 2016, it is available on our website under the Communication tab. So please feel free to visit the website and have a peek. Well, our discipline, as we often refer to it, is at all times to protect our and our clients' capital, and especially so when we see the warning signs of potential problems. We are not alone in this thinking. Cash and cash equivalents are important defensive assets. I say this regularly. We cannot stress this enough, so we are carrying greater than normal cash balances in our models at the moment and waiting for asset prices to get more reasonable, to more reasonable price points before we commit long-term capital. Now, interestingly, different asset classes that you see on this matrix here are represented by the different colors. You don't have to look specifically at each one. The idea is to get a sense that the performance of each of these asset classes is ordered by the best performing being placed at the top of each column, the worst at the bottom. Now, each column represents each year from 2004 on the left to current times. The point here is that, as you can see, different asset classes perform differently at different times throughout that longer term cycle in a not necessarily predictable manner. That is why a portfolio needs to have diversity, to have many different asset classes working, so that when some are working but others may not be, you can still benefit from those that are doing well. Now, regular rebalancing by selling the outperforming assets and buying underperforming assets is an important part of adding to the potential for long-term growth. Well, our HIROC models are built to incorporate the need for diversity with fixed income, global equity, and tactical mid and small cap companies. Okay, well, let's see what's happening on the agenda for the upcoming week. In fact, tonight we have the U.S. State of the Union address by President Obama, and we will see Chinese trade data that is usually somewhat interesting to see and does have some impact on markets on a global scale. Tomorrow, we will see the Euro area December industrial production. On Thursday, as I said earlier, the Bank of England will have their interest rate decision. Friday, we get U.S. December retail sales. They're going to look at what is transpiring for the U.S. consumer, which, of course, is representative of about 70% of that economy. On Sunday, we get Japanese December industrial production. On Monday, it's a U.S. holiday with the Martin Luther King holiday. We also, at that point, will get the glimpse of China's fourth quarter gross domestic product, plus their industrial production and retail sales. Next Tuesday, we get UK's December inflation, as well as the Euro area December inflation. Well, that's it for today's discussion. If anyone who is listening might have a question, please feel free to ask it now. Okay, well, if you do have questions and wish to email us, we would be more than happy for you to send them. We would also love to get feedback on these webinars, what you think is good, what is not, or what else you might like to see us cover on these calls. As always, we want to thank you for taking the time to tune in. We want you to have an excellent rest of the week and a great weekend. We will return with another webinar next Tuesday. And this is Scott Tomlinson signing off.